Trading can appear complex. Charts with lines and indicators can feel overwhelming, but at its core, trading is simple. It's about understanding supply and demand. These forces drive every market from stocks to currencies. Mastering them can unlock consistent trading profits. Supply and demand zones are specific price areas. They highlight where buying or selling pressure is significant. These zones act like magnets. They attract price towards them, creating trading opportunities. By identifying these zones, you gain valuable insight. You can anticipate potential price reversals or breakouts. Think of a crowded store having a massive sale. Demand explodes as everyone wants the discounted goods. In trading, a demand zone is like that sale. Prices are attractive, drawing buyers in and pushing prices up. Conversely, imagine a store overflowing with unwanted items. Supply is high, forcing the store to lower prices to attract buyers. In trading, this is a supply zone. Sellers are eager, pushing prices down. Understanding supply and demand is key. It allows you to see the market from a different perspective. You're not just following lines on a chart. You're understanding the forces driving price movements. By mastering these concepts, you can transform your trading. You can move from reacting to anticipating. This is the power of supply and demand zones. Many traders rely on traditional support and resistance levels. These are horizontal lines on charts indicating past price points. The assumption is that price will likely reverse at these levels. However, these tools have limitations. They lack the context and precision of supply and demand zones. Imagine support and resistance as basic landmarks. They tell you where you are on a map, but they don't reveal the underlying reasons for price movements. Supply and demand zones, on the other hand, are like detailed maps. They not only show you where the price is, but also why it's there. They reveal the underlying forces driving the market. Supply and demand zones consider the volume of trades. This is crucial. Volume confirms the strength of buying or selling pressure. This makes zones more reliable than traditional support and resistance. Another advantage is their dynamic nature. Supply and demand are not static. They fluctuate with market sentiment. Zones can expand, contract, or even disappear as the balance of power shifts. Traditional support and resistance lines are often drawn arbitrarily. They lack the context of market dynamics. This can lead to inaccurate predictions and missed trading opportunities. By embracing supply and demand zones, you gain a significant edge. You move beyond basic chart patterns to understand the underlying forces driving the market. This allows for more informed trading decisions, increased accuracy, and ultimately greater profitability. Identifying strong supply and demand zones is crucial. These zones have the highest probability of influencing price. But how do you find them? The key lies in understanding market psychology and recognizing specific chart patterns. One of the most reliable indicators is a strong impulse move. This is a sharp, decisive price movement in one direction. It signifies strong buying or selling pressure. The base of these impulse moves often forms powerful supply or demand zones. Think of it like a rocket launch. The initial thrust propels the rocket skyward. This initial surge leaves behind a launch pad, representing the supply or demand zone. Another key element is consolidation. This occurs when the price moves sideways within a tight range. It indicates a balance between buyers and sellers. However, this balance is often temporary. A breakout from a consolidation base often leads to a significant price move. These breakout points are prime locations for supply and demand zones. Remember, not all price movements are created equal. Focus on areas with significant volume and volatility. These are the zones where institutional traders and market makers are most active. Their actions create the most powerful supply and demand imbalances. By mastering the art of identifying strong impulse moves and consolidation bases, you unlock the door to identifying high-probability supply and demand zones. These zones serve as your trading compass, guiding you towards potentially profitable opportunities. Marking supply and demand zones accurately is essential for successful trading. It's not about drawing random boxes on your charts. It requires a keen eye, understanding market context, and following specific guidelines. The first rule is to prioritize quality over quantity. Don't clutter your charts with numerous zones. Focus on identifying the most significant ones. These are usually found at major swing highs and lows, marking significant turning points in the market. When drawing your zones, use rectangular boxes. This helps visualize the price area where supply and demand were imbalanced. Avoid using simple horizontal lines. Lines lack the visual representation of the entire zone, potentially leading to inaccurate trade entries and exits. The width of your zone is crucial. Avoid drawing zones that are too wide. They become less significant and can lead to false signals. Aim for zones encompassing the price action of the impulse move or consolidation base. Remember, the left side of the zone is crucial. This is where the imbalance originated. The right side of the zone, however, can be more flexible. As price revisits the zone, it might not perfectly touch the previous boundaries. Accurate zone marking requires practice and refinement. As you analyze more charts and observe market behavior, you'll develop a keen eye for identifying and marking high-probability zones.